Now, it may have been expected, but a deeper economic slump forecast is definitely not good news on any day. Here to help us make sense of those numbers, we have Security Bank's chief economist, Dan Roces. Good morning, sir.
Hi, good morning.
So let's kick off, of course, with those
Yeah.
DBCC projections. A lot we're already expecting them to downgrade that. But to what extent was this, a surprise? To what extent can you actually figure out which are the main culprits for this downtrend?
Well, the DBCC themselves said it. No, it's primarily because of the lockdowns. They've begun to recognize the effect of all those lockdowns. Well, for one, mobility. Second is on the general compression of economic activity. So that was actually a long time coming. No, we were expecting it to be released immediately after the third quarter GDP numbers went out. And a lot of analysts, including myself, actually downgraded the view further once those numbers were out. So so it was expected to be along that range. But
Sir, what
likely that's going to be on the deeper side. Yeah.
What about the predictions of growth in 2021 and 2022? Are
Mhm.
these necessarily better than you were forecasting, especially after that slump? They're still seeing 8 to 10% growth. Is this something in line with the budgets that they are proposing for the next couple of years?
Okay. One thing about the 2021 view is that it's for one, it's purely mathematical. If we go by the year-on-year growth figure, let's assume it's 7%, 7.1% is our view. That means that the real GDP number, if you look at the value, that's um, uh, below the 2019 actual real GDP growth value as well. So that's not
Mm-hmm.
growth per se, but it's recovery nonetheless. No, it's actually
Mm-hmm.
it's better than 2020 at least, but we're not yet there in terms of overtaking the growth potential that we were supposed to look at. No, so any number around 7.5% growth figure is still a recovery figure. So that means it's going to be that means recovery or the true trajectory might begin by 2022, and will likely get to the 6% levels, which is the target all along, by around 2023. No, so that's the situation. If you take a look at the actual figures. Now, what could accelerate growth? One is the vaccine, of course. So if it's going to be widely distributed by the second half of next year, there's going to be ripple effect. Even if it's not going to be distributed here locally, at least, or a wider distribution does not happen here, there's at least going to be a ripple effect to us, which could be positive, primarily on the trade front. No, and more
Okay.
economies will likely be starting to open up, so that would benefit our OFW workers as well. Remittances numbers will bounce back. Um, Production also will, because there's going to be higher manufacturing orders, so that's going to prove better for our export numbers as well.
Mm-hmm.
Yeah, so that's one. Second is, of course, we need a fiscal stimulus to complement what the monetary authorities have done. No?
Mm-hmm.
In an expansionary macroeconomic policy, it has to go hand in hand. No? So what we're seeing right now is a prudent response on the fiscal side, which we can't fault the government for, because it's the tax base has essentially been destroyed because of all the business closures and some economic difficulties that we've been seeing locally.
All right, sir. One other economic data that, of course, we have to digest unemployment figures. That is
Yeah.
to 8.7%, at least for the month of October, when you compare that to the highs that we've seen so far this year. But one other interesting thing here is that, there are still challenges when it comes to labor force participation rate here. The question is, when do you see the job market actually returning to pre-pandemic levels, and what's it going to take for us to actually get there?
Okay, well, it's interesting that you mentioned labor force participation rate. Um, that actually went down based from the July figure to the
Mhm.
one that was released yesterday. So that's a red flag that we have to watch out for, because primarily it means more people are dropping out from the workforce, likely because it's proving too hard to find employment. So they dropped out altogether, probably holding on, waiting for their fortunes to turn as the economy recovers. So that's one, because um, further compression in the LFPR will mean that there's going to be some compression as well in household consumption, and we don't want that because that's 70% of GDP as well. Okay, so recovery will come in employment once more. What it's going to go lockstep now in terms of more reopenings in the economy, and likely more businesses that will get revived. So that's where the pickup will come from. But until such time that there's still low confidence in terms of business, in terms of the business environment, that's going to be uh, that's going to be or the unemployment rate will still be at elevated levels. No, our projections is actually that by next year it might not be at our natural rate of unemployment, which is around 5%. It
Mhm.
could still be at 6%. We'll likely reach that figure by 2022, under the assumption that there's already full recovery by then.
This means, sir, that by come next year at least, they're still going to be hard pressed when it comes to consumption levels.
Um, Hopefully not. With more people getting employed, and as I mentioned earlier, if we assume that the OFW deployment becomes better, that's going to rebound to some positive consumption levels as well. But like I said, locally, the challenge actually lies locally. If we have to see more businesses reopening again,
Mhm.
um, something akin to a new normal, but not yet quite there, right? So, yeah. So,
Sir, I just want to
consumption.
jump on
Sorry.
that consumption point, sir, because a lot of that has to do with the stimulus, and there's such a
Mhm.
huge debate on whether the stimulus is enough. You've got you already mentioned Ben Diokno of the central bank saying you can't just use monetary policy. He's been calling for more fiscal support, but you've also got Secretary Dominguez saying that kaya naman.
Mhm.
If the confidence is actually there, that's actually
Mhm.
enough already. At what which side are you on? I know you can't take sides, but at the same time, they've also capped, the budget deficit lower for 2020. So what does that mean? Does that mean that they're going to be spending less than what was actually initially planned? And how is this in relation to what we need to be spending in order for consumption to spur?
Yeah, well, capping the budget deficit might likely mean that it's going to stop there. No, I think from the January to September budget deficit is already at 6.7%, if I'm not mistaken. No? So we still have some room to reach the target of 7.6%, but likely, well, it came from them themselves. They're going to cap it at 7.6% GDP. So what that means is actually, well, we might have run out of time because it's already December. The budget needs to be zeroed out in order for it to get launched next year. So likely the fiscal spending that we are looking for might start by next year when some of the legislations get passed, if at all. Bayanihan 3 will prove to be a targeted fiscal stimulus package if it gets passed. No? So, but there are other legislative priorities. I think that's also geared towards towards the fiscal front. Now you have create, you have the FIST bill, likely if any uh, targeted fiscal stimulus bills will get passed. That's likely going to come after those priority bills. No? But like I said earlier, uh, fiscal support needs to happen in order for the monetary side to also get going. No? We're seeing already some pressures coming in from the monetary side. Also, that's slightly born out of the need for a support mechanism for the policies that have been instituted already.
Okay, sir, let's close with that monetary policy. You're
Mm-hmm.
already saying we've had inflation higher than
Mhm.
expected for the last sprint. Is this a good
Right.
thing? Meaning that on the one hand, we know that the supply side was affected from the storm. So on the other hand, is there some sort of demand, light at the end of the tunnel saying that
Mhm.
consumption might be picking up here? And at the same time, how does this affect the policy, which has already been preemptive, which already did a surprise cut? Ano pa bang kayang gawin ng BSP here given the fact that the loan growth has been slowing compared to previous months?
Yeah, well, the challenge lies right now with the BSP in terms of nudging loan growth as well. You know, the negative interest rates that we have will only serve to erode with the cash holdings of
Mm.
people. No? So if they keep it in banks, it's going to well, the value is just not there. No? So the correct way to go is to invest it. So I think that's also one of the nudges that the BSP wants to push for. So the challenge right now is how to restore business and consumer confidence back to a level such that it's more acceptable to investors in order for them to take out loans once again. No? So
Mhm.
that's the challenge. In terms of inflation, uh, well, the print was a surprise, no? And I think it has something more to do with cost push inflation.
Mm.
It's not necessarily higher consumption levels, although it's there. But I think it's more. It has something to do more with the effects of the typhoons that we had. No? So it
Mhm.
likely compressed the more volatile component, which is food. So we're looking at supply compressions there. So likely that's what pushed inflation levels to the level that we saw right now, which is actually a surprise. Yeah.
Okay, so at the moment you're actually looking at negative real interest rates, but as you mentioned, sir,
Mhm.
it's going to need a bit more of pushing for all
Right.
of that money that's going around in the system to actually enter into the real economy and into the pockets of consumers. So thank you so much for those insights. That
True.
was Robert
Thank you,
Dan
sir.
Roces, Chief Economist of Security Bank.
Pleasure. Thank you.